Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world, Options Trading Academy. Let's talk about how I lost money on this DWAC play. And the reason why I'm showing you this is because I want you to understand, right, that as a trader, you're going to take losses first off. You're going to take losses. And you got to understand that. And so you really want to try to implement rules of how you're going to trade to try to mitigate those losses, right? Because losses are part of trading. You're going to take losses, but you want to create rules to try to mitigate losses. And I'm going to show you that when you don't follow your rules, you normally lose more than you would lose if you did follow your rules. Because even by following all your rules, you're going to take losses. However, if you don't follow your rules, it's almost guaranteed that you're going to take a loss. And then kind of based on how you're trading, it can show the size of the loss. So we're going to go ahead and get into that, right? Because I understand that most traders don't show their losses, and we're going to talk about this DWAC loss. Now, I lost around 90% on this play. It was a around a $300 put contract, and I should have never bought the contract. I should have never been in this play, right? That's the thing. I should have maybe paper traded it. I should have never live traded it because it went against the majority of my rules under how I trade. And that's why I want to show you is that when you don't have any rules, right? What happens is you do things and it doesn't work, and you don't know why it didn't work because you don't have any rules. And then if you do win, you don't know why you won because you don't have any rules. And that's why I tell people a lot of times your life is a byproduct of your trading. People that don't have any rules in their life, they come into the trading space and they trade without any rules. Therefore, if they win, they don't know how they won. If they lose, they don't know how they lost because they don't have any rules of operating. Because I actually do have rules, I can look back and see and say, you know what, David, you violated your own rules, which is why you lost on this play. Because if you would have stuck to your rules, you probably would not have been in this position. But win or lose, I violated my own rules. And that's what I want people to understand. A lot of times you should analyze a play by whether or not you stuck to your strategy as opposed to whether or not you made money or lost money. Many of us have a narrative as long as it makes money, as long as it's profitable, it's all right. The problem is, it means you just go for everything. And then that's one of the challenges that a lot of people have when they come into the trading spaces because they don't have a structure that they're operating under. They just try to go for everything. And then when that doesn't work, they don't know how to build back up off of their structure. So let's go into it. So now we understand that DWAC is supposed to be this corporation that's going to merge with Trump Media Technology Group to be this alternative social media play. Now, what happened was I was observing this because we know about Elon Musk buying Twitter. And what happened was around the date that it finally came out that Elon Musk is going to be able to buy Twitter, which is the 26th of April, which I believe was a Tuesday, I went and I acquired at the money puts on DWAC, right? So here's the 25th, here's the 26th. All right. So I got around at the money puts on DWAC at that particular time. And one of the challenges is that I made a lot of mistakes. One, I should have never been in this play. Then I made a lot of mistakes, right, in the way I set this play up. I made a lot of mistakes in my execution of the play. And the big thing is, like I said before, is I never should have been in it. And we're going to kind of talk about that. What happened is the news came out and I was under the impression. So this was my narrative. This news is going to come out about, Musk buying this. Twitter has essentially the network advantage where everybody's already on Twitter. We already know that a lot of these people that's going to, say we want an alternative media source, yada, yada, yada. Man, they not going nowhere because all they need, we talked about before, is they need to be polarized and to be relevant. Therefore, if they go to DWAC and everybody thinks the same way as them, well, then nobody cares. Because in the social media space, a lot of times, most people believe I want to agitate and polarize people to get their attention. So they looking to be as controversial as possible because that's the only way they can get attention. They're not here to teach nobody anything. They're not here to elevate people. They're just really here to agitate people. Therefore, if everybody agrees with me, then I can't agitate them. So when it came out that Musk was going to buy Twitter, what I felt was that the market was going to get even more bearish on DWAC. And if you look at the chart on DWAC, we see that they're around $100 at one time and they just kept selling off. And what I saw was that looking at their, look at the 3 month, they haven't really been trading that long. They got a support at around $42. We got another support at around 50. And they were at that time trading at around, they opened up at 36 that day. So I got at the money puts. Now, here was a mistake I made. I didn't make a mistake buying at the money. The first mistake I made, and we're going to go ahead and break it down, right? Because what happened was, and let's go back to the chart. After that news came out, DWAC started going back up towards the resistance, which is around $50. As opposed to falling under the support, it started going back up towards the resistance, right? Which is around 50. It got to 53, and essentially that became the resistance again. And now we're trading at around 42. But it stayed in this, in this range between 40 and 50. It's been in this range since March. And therefore, I had to exit because instead of it continuing to sell off once that news came about Elon Musk buying Twitter, for some reason, people started to buy into it, started getting accumulated again, which was weird to me. But, the market doesn't always go the direction that you think it's going to go. That's how this works, right? However, I made mistakes in this to where I should never been in this play. We're going to go ahead and go into it, so we're going to break it down. And therefore, you can maybe see this in your own trading and kind of understand where you can go wrong at, because what I don't want you to do is be on a really good streak of winning and then turn around and go on a bad streak and essentially just, kind of like invalidate or X out everything you've done to win. And I've seen that happen to people. You get up 40 grand and over the next 90 days, you lose it all again. Because why? The rules in which you are operating under, you weren't following the rules. You're just trying to make money in the market. That's cool. But professional traders trade under rules. In fact, professional traders have risk management that tells them, hey, you got to get out of the trade. They got risk management that will cut their computer off. And if you just lose too many trades, they just fire you. They're not going to let you just blow all of their money. It's their money. And I want you to understand that. So let's break down what I did wrong on this play. First thing I did is I bought with really high volatility. Volatility when I bought this contract, I want to say was over 150%, right? Because it was a very volatile ticker. Because one, it had been falling really hard, and because of a lot of the controversy around this play. So I normally try not to buy volatility over 100. I usually look to try to get between 50 and 100, right? I will sometimes get over 100 in a specific circumstance, but I had no business buying a volatility over 150. It's way too high. It's way, way, way too high, because what it means is now the forecasted move essentially has already been baked into the price of the contract. Therefore, I have to exceed that forecasted move to make the premiums go back up within that amount of time. Now, the second thing I did wrong, I bought a weekly. Now, I hardly never buy weeklies anymore. Used to do a lot of Tesla weeklies in around, I want to say 2020. I got out of that game because it's just, to me, I couldn't figure out how to get a track record of success with what I was buying. Now, maybe would I buy weeklies on something else? Yeah, but I rarely buy weekly contracts. I bought a weekly. So I bought a high volatility weekly. Therefore, if I don't immediately start getting, literally the moment you buy it, if you don't almost immediately start getting that movement, you're going to start losing premium, because what are you getting? You're getting theta decay because it's such a short-term contract based on what your IV projections were. So I bought high IV and I bought a short theta. That was a mistake, right? Now we're going to go again, high IV. You got to be wary of buying contracts with a high IV, because what the market is saying is that we already believe this to be a fast mover, whether it's on the call side or the put side. You're buying it in agreement with them that it's going to be a fast mover. What happens if it doesn't move fast? You're going to start to get a loss of premium, because what they're going to do is they're going to reset the volatility projection. So if you buy in at a volatility of 150 and it's priced for 150, and then it starts to trade sideways for the next 4 days, they now reset the volatility to maybe 100. You're going to lose premium value just on that. And that's why you got to be really wary of high volatility, especially along the timeline in which you're buying it at. Next thing I should have done is I should have set a tighter stop. So I lost around 90% on this play. Should have set a much tighter stop, right? Should have set it like a 10% stop. And it should have set the conditions to exit at 10%. And that was the first thing, is that I set too wide of a stop. And then it started to go in the opposite direction. And I should have set a much tighter stop. And it had a lot to do with the fact that I should have never been in this play in the first place. Next thing I did is I overtraded. So the biggest thing I overtraded. I was already in too many trades when I got into this trade. But a lot of times you can be into a lot of trades and they may be longer term trades and you start looking for shorter term trades just to have something to do. That can be a mistake because what you're doing is you're over trading out of boredom. You don't ever want to do that, right? You don't ever want to do that. You don't ever want to trade. If you're managing an account on behalf of your family or you're managing an account on behalf of a fund, you don't want to enter into a position just because you're bored, right? So, you may have a fund where they may be up this year already at 30%. When they exit out of all their positions, it may just be time to just sit down for the rest of the year. Why? Because we're already up 30%. You don't want to trade out of boredom. And that's one of the downsides. And I wouldn't say downsides. That's something that people have to emotionally manage in this space is you can be so successful in such a short amount of time. You start dealing with boredom because you don't really know what to do now. You may have made $30,000 in a month, right? Well, you normally will make that working all year plus 10 more thousand. So let's say you work all year to make 40,000, 45,000 before taxes. Now you've made 30,000 in 90 days. Well, now what do you go do? Because how do you fill your time up? And what you'll find is a lot of times you'll start going into trades just out of boredom. I'm just bored. I don't have nothing to do. So you got to figure out. So, I watch, like what Mecca does. She does stuff with her family. She has activities to occupy her time because when you're making money, a lot of times in a non-traditional space, once you figure out how to do it, you can start dealing with boredom because it may not take your whole day, right? Or you may just be up because you had a really good run. And then now you start, doing things to occupy your time, but you're risking your gains to do that. And so that's what I did where I was positive on a lot of longer term plays. Then I started looking for shorter term plays just to have something to do. I just wanted to be in a trade. And that was my mistake. I should have stuck to my trading journal and doing what I needed to do instead of trying to find something to do to occupy my time on a shorter time frame. That was my mistake. So over trading is how I got into this position. Then again, I went against my rules. So I have certain trading rules set up. I went against those rules just to be in this trade. That's always a mistake. And if I'd have been trading for somebody, I probably would not have been allowed to go into this trade. Why? Because I'd have been violating all the rules of the particular institution I was trading for. However, because I make my own decisions on trading, I decided to override my rules to get into this trade, and I lost 90% of the play of the capital that I put into the play. So it was around $300. So I lost about $270. That 300 could have been 3,000. That 300 could have been 30,000. That 300 could have been 3 million. Right? It's not about the number. It's about the percentage loss, and it's about the fact that I violated a lot of my rules to get into this play. And that's what I want you to understand is that this is nothing but a psychological game. The mathematics are very easy. To me, the fundamentals of the market are easy once you apply yourself to it. To me, driving down the highway is more difficult than trading. And it can be more detrimental. I can bounce back from this. You can't bounce back if you die on the road. However, most people don't want to master or really manage effectively the psychological aspect of this game. That's what most people lose at. They don't lose because they don't understand the Greeks. They lose because they have a psychological breakdown that costs them money. And then what they say is that, I'll go to some place that is not as psychological challenging. Let me go to an area where I can run on autopilot. Let me go to an area where I can make money, surf social media, have a conversation on the side, and they still gonna pay me. Because that's easier psychologically than for me to have to really master or really manage effectively my psychological ability. Really have a good control over what goes on inside my head. Really sit back and look at my decision-making ability and say, where did I go wrong? You see, I didn't blame the market for what happened, right? It's not Trump's fault. It's not Elon Musk's fault. It's my fault. I made the decision. I went into my brokerage account. I bought the contract. I didn't set a tight stop, right? I bought a contract that had extremely high IV on a short time span. I made multiple decisions to put myself in this position. Nobody influenced me. Nobody induced me. I did it all myself. I created a story inside my head that made this make sense. So when it goes wrong, I can't do nothing but look at what I did. And that's why a lot of people aren't successful in this space, because we know now, because of social media, people have built whole big platforms telling other people it's everybody else's fault you don't like your life. You understand me? And that's what I want people to understand. So look at my situation as an example. Try not to make this mistake. But if you do make this mistake, have the ability to look back at what you did and just start looking at it step by step and start picking it apart and realizing, okay, well, what did I do wrong to put myself in this situation? And then how can I monitor this to make sure I don't put myself back in this situation? Because, one of the things I really had to learn to be effective as a trader is emotional management. I have to really manage my emotions very well. And what you see a lot in the mainstream society is people that don't have good emotional management. That's why I tell everybody that wants to learn how to trade to read the crowd. This society really is able to benefit from people that don't have good emotional management. They just don't manage their emotions. It's not about being emotionless, which is impossible. It's about management of emotions. You can feel however you feel. It's the actions you take behind how you feel is what's going to either get you in trouble or allow you to become successful. And that's what I want people to understand. You got any questions about the highest paid part-time job in the world? Reach out to me. Like I said, we're going to be raising that price at the end of this quarter. And, the CPI data, even if it comes out lower than expected, it's still going to be in the 8s or either the high 7s, which is going to be a conservative estimate. Because CPI is really in the 15s if you look at food and gas, right? But they know how to extract the numbers that's really going to skew it up. And as a result, the cost of business is going to be higher. I know definitely when I get ready to start running my ad campaigns, the cost of advertising is going to be higher, which means it's going to cost me more money to make money, which means that cost of doing business is going to go up for me. And, as businesses work, you have to add or drive those costs back to your customer. That's how business works, right? I don't have the ability to eat the costs. Okay. David W. Williams, also known as Diamond Dave. If you have any questions, hit me up in the comments. Talk to you later.